Right.
Well, we've been talking about active, and you mentioned fixed income, but this has been a year for fixed
Yeah,
income.
I was going to say, we got to pivot to fixed income here because the flows have definitely been there. I mean, everybody all of a sudden knows how to get 4% out of the bond market, so everybody's doing that. But at the same time, I've talked to some advisors that are just absolutely avoiding credit at all costs. I have a webinar later this month with Eric Beagleisen from 3Edge. Their core model is 100% treasuries right now. Their core moderate model, no equities whatsoever, no other credits, just government issued securities. That strikes me as incredibly conservative, and we'll get to that with Eric at some point. But is there an issue in the bond market where there's just not that much interesting for investors to do there? It's just duration and credit?
Well, yes. I mean, it is just duration and credit. And so you can either hide under the mattress with your ultra short bond ETF, whether that's a treasury oriented product like BIL from State Street, or SHY, which is an iShares product.
Or more of a managed approach, like a Mint or something
like
that.
So, right.
The
cash-like actively managed ETFs. I think we are going to see, now that it's quite possible that we just had the latest and last Fed rate hike for a period of time, that could cause folks to pay a little bit more attention towards the middle of the curve, and take on a little bit more rate risk, intermediate term products or active products that are in the core or the core plus variety. And that's where we've seen so many active managers that have an offering. So they have entered active fixed income more than they've entered with active equity. But we've got firms, I could name them all. I'm probably going to forget some, and then we're going to end up having people wonder, why did we leave them out? But everybody who has an active mutual fund that entered the ETF marketplace now has a core plus fixed income product, and they're perfectly appropriate for this kind of environment. I think you did it in the VettaFi Voices. Why would you want to try to manage this yourself?
Yeah, well, that's the thing that's really nuts, is that the corners of the market that look the juiciest when I talk to PMs are often the ones that are hardest to cover as an individual investor. So for instance, like PIMCO has a loan fund, I think it's LONZ is actually the name of it, that's done quite well and has some really interesting exposures. That's a market that's basically inaccessible as a retail investor. I mean, there's no way you're going to figure out how to pick that one credit out of the giant basket that is going to yield that excess return, which is what you're hoping to get. I'm wondering if there's an opportunity here for more packaged products around these fixed income strategies. I see the active strategies. I understand the case there. But is there like a smart beta version of this for fixed income that we're ever really going to see?
Well, we have smart beta fixed income products that are tied to managing the duration risk. Goldman Sachs has a whole suite of those products that are smarter, at least in the intention, than the traditional issue-weighted index-based approach, whether that's to corporate bonds or investment-grade corporate bonds. GIGB, GIGB is one of the tickers that comes to mind, but they've got a high-yield version. I think they even have an emerging market debt product as well. You've got Invesco that has these products. iShares launched these products. There just wasn't money going into it. Perhaps now is the time to be able to do so, especially as we talked about smart beta coming back again, perhaps with a quality tilt towards some of these strategies. I don't think, what we perhaps could see more of are these fund-of-fund strategies.
I don't think so.
Where somebody's managing which ones of those products and rotating in based on the investment style.
I don't see there being a big market for that. I mean, the one ticker problem is a real issue with financial advisors, certainly. I've had many advisors tell me, I don't care how great your model is, if you put it in one ticker, I can't use that with my client. I can't tell them I'm putting all of their money in some balanced fund, no matter how great it is. The flip side of that is we now have the tools in the fixed income side to do some really interesting stuff. You've got the sector stuff from bond blocks. We've got lots of target maturity and specific duration models. So if you are a bond nerd, there's a lot of tools to play with, but I haven't seen anybody really rolling it up in a particularly compelling fashion just in the bond space. It feels like there's still some green field there.
So a couple of things to it. One, yes, a shout out to Bond Blocks because they've got some of those unique products that are out there if you want to choose not only your duration with a single treasury product and there's a couple other
financials versus tech and all of that.
But being able to overweight and within the high yield space. But what we've started to see is some of those asset managers that we talked about earlier that have a huge following within the balanced world. have shown some success with fund-to-fund strategy, or they think they're going to. So Dimensional Funds launched a fund of equity ETFs, again, equity, not fixed income, that launched in September, that already crossed $100 million in assets under management. I'm failing to remember the ticker off the top of my head because 3,000 of them are bouncing around in this head, and I'm not as young as I used to be. And then Capital Group has launched, or not launched, has filed to do a balanced ETF that it's going to include equities from a stock picking perspective, and then using their own, likely their own fixed income ETFs to get that exposure. Capital Group and Dimensional have certainly proven that they know how to bring in money into asset allocation strategies. Not in ETFs yet.
It feels like that's a retail play as much as anything. I think the average advisor isn't going to touch that. I think the average institution is not even going to look at it, right? Because they do that on their own. But from an advisor perspective, it seems like that's just competing directly with model portfolios, right? I mean, if you're going to go in all in on a Capital Group single ticker ETF that's balancing out your credit exposure and your duration and your equity exposure and managing your international sleeve, there's nothing left for the model provider to be there doing, and I think that's a real issue in this industry.
Right, but advisors, as you know, add value in other ways besides the security side, and so for some folks, that's for smaller account sizes, that's just an easy thing to be able to do, or to be able to manage that as a core and then build around that using, you have that as your core, and then you add individual securities or individual tickers
to build around it.
That's related to it.